So I finally did it. I sold my Loblaw stock. And the primary reason for it is just it kept going up in the market. I don't feel like it's a great place to continue buying shares, as I think that is trading at a pretty fair, maybe slightly overpriced valuation at the moment. You're paying a 19p for this company. It's true that food inflation is going to come along, but there are other stocks in my portfolio that fell a lot, and I decided that the money would be better served there, and I should do better in the long term, maybe not in the short term, because I do believe Loblaws could continue going up, but I don't see myself buying shares at this price, and I believe there are better opportunities. So if you want to follow along with my portfolio updates from week to week, please subscribe to the channel, leave a comment, share the video, and let's get started with the intro. Looking at the TFSA, it looks like over the last week we actually climbed up a little bit. It was negative today, but overall it's looking good. And then for the all-time performance of the TFSA, we're still down about 4%, so down 559. But, every sector is pretty much, every stock is being sold out of, regardless of what's going on with the quality of the company. So nothing to worry about here. I just get a chance to buy more shares at a lower price. So you can see, things are generally going down no matter which sector you're looking at. So technology's down. Even renewable energy is down. So AQN dropped. Alibaba's actually had a nice little resurgence here. So it's actually at 116. So we're climbing out of this red. Let's see if that can continue. And I bought one more share of Brookfield, so we went from 12 shares to 13. I really like this in the mid to low 50s, so I decided to get one more share of Brookfield. I think it's a great price to add to our position here. And with the proceeds of the Loblaws sale, I did focus it into Scotiabank, because this is paying almost 5.4, almost 5.5% yield right now. So we bought 3 more shares of Scotiabank, so we went up to 18 shares, and we're actually going to get a $19 dividend approximately in the next month. So definitely looking forward to that. It's going to be our biggest dividend in the portfolio to date. So very excited for that. And I have not seen Scotiabank at these prices for about a year, maybe even a little bit longer. So definitely really going to take advantage because Scotiabank has only improved its fundamentals from a year ago, and there's no reason for the price to come back down as a result. It just doesn't make any sense. And we can see that our income funds are doing okay. So our Canoe EIT is holding up pretty well, still in the green. And ENS, which is just Enbridge, is also holding up because that's in the energy sector, very stable little company. That's also in the green. Ethereum is still completely destroyed into oblivion, so it's still not looking good here. And another thing to note with this ETF is that when the price of Ethereum is down, the fund manager will actually make fewer covered calls, so your income will be lower as a result. So we'll see what it actually turns out to be, but the income will come back if the price comes back up. So hopefully that happens, but just a small position. If it goes to zero, so be it. That's why we only put in $300. So not the end of the world if this goes to zero, but hopefully it recovers. And we added a little bit more to Google, just a tiny bit more Google, not much. And I added another share of Intel, so we went up to 17, just bringing our average down in this, because sub 40 I think is a pretty good price for this business, even though in the next few years it's not really looking too hot for Intel, just because they're spending a lot on capital expenditures to make those chip making facilities, and their free cash flow is going to get hit in the short to near term, but I do believe long term that it will pay off. So that's why I'm buying this stock now, while I believe it is very, very undervalued. There are risks, of course. It may not work out. That's why we're going to keep this at, maybe about a 5% position in our portfolio. I'm not going to go super heavy or all in into this, because it definitely has its upsides. It has its downsides too. So we're just going to manage that risk by limiting the exposure to something I'm comfortable with. And we also bought one more share of TD. So we went up to 16.5 shares of TD. Honestly, my first 2 shares that I bought were at about $83. So to see this at 84, and after the dividend raise, I've never seen TD have a yield of 4.25%. So it's just absolutely insane that it's just going down, because the market fears that we're heading into a recession. And maybe we do, but the banks are going to do just fine, and then higher interest rates benefit the banks. They're going to make more money off of loans, more money off of mortgages, especially if they're not fixed rate. If they're variable rate mortgages, people are going to be having to pay those higher mortgage payments every month, and the bank is going to benefit from that. So definitely really, really like this bank, especially because of their acquisition of the First Horizons Bank in the States. So they're going to become the 6th largest bank. So TD has never been stronger. And once that acquisition goes through, should be in the next year or so, from what I'm reading. And they're going to grow at a pretty high rate. So the price going down, I mean, I don't mind at all. I will keep buying TD. I'll keep buying Scotiabank. If you're out there, you want to keep selling your shares, I'll buy them. If you don't want them, I'll buy them for less than they're worth. I think they're very good values, and that's the main reason why I sold Loblaws. Not because it's not a good business. It's just, why would I buy a business that's fairly valued when I believe the banks are undervalued and are paying extremely high yields, yields that I have not seen in a very long time. And they grow their dividends every year, and they've paid stable dividends for hundreds of years, and that's just a track record you can't beat. And that's why TD and Scotia are both about 10% weighting in my portfolio, with Apple being 3rd place at 9%. So those are the 3 businesses that I find are very, very well valued, and they're definitely core holdings that I plan to keep for the long term. Not looking to trade them. I'm only just looking to buy, accumulate more, reinvest the dividends right back into the business, keep increasing our snowball. And I'd like to get TD and Scotiabank to the point where every 3 months I have enough to buy a free share of them going forward. And the RRSP in the last day, up a little bit, actually up 5% this week, and all-time still down 6%. But we only have the one holding, so we only have Starbucks. So I decided to buy a little bit more when it was at about 75. So we went up to 5 shares. So I just put in $35, bring us up to 5 shares. And I just like it. So if it goes down below 70, I'll probably put a little bit more focus into this. But right now I'm pretty happy with where it's at. And on the watch list that I'm interested in adding to my RRSP is Costco, but the price just isn't where I want it to be. I want it to be below 400. It's a great business, but definitely want it to be lower. Lowe's is another one where I've compared it to Home Depot, and I think this is trading at a much more attractive price than Home Depot, and should grow the dividend at a very high rate. It has a lower payout ratio than Home Depot, so it's much safer. They can grow their dividend. And they're just much smaller in size, so they have probably an easier time to grow the business into a larger one than a Home Depot would. And also one ETF, which is SCHD. So with this one, it's 100 dividend stocks, and the average PE ratio of this ETF is 14, well, just about 15 or so. And the great thing about this fund is that it's just tracking 100 dividend paying U.S. equities that grow their dividend over a long period of time. And this fund has actually outperformed the S&P 500 because you've done 58%, and they've paid you a 3 or 4% yield every 3 months. So the reason why I'm putting this in a TFSA and the RRSP versus the TFSA is that as a Canadian, you don't have to pay the 15% withholding tax if you have your American stocks in an RRSP. So that's why I decided to put Starbucks in there, because I'm just planning to reinvest the dividends every single month. And for the dividend income in the portfolio, so far from the last update, we've actually increased our annual dividend income from $7.52 to $7.82.98. So that's an extra $30 a year earned passively for doing absolutely nothing. Our monthly income went from $62.68 the previous update to $65.25. So we're getting closer to our goal of hitting $3 a day. We just got to get this up to a little bit over $90. So we'll get there a couple dollars at a time, and as the dividends grow, this will keep compounding and growing faster and faster. We're making $15 every single week just from our portfolio, just doing its thing in the background. And every day we're earning $2.15 per day, and last update it was $2.06. So we can definitely see an increase there. And it takes 1.53 months to earn $100, whereas previously it took about 1.6. So that time it takes to earn $100 continues to shrink from week to week. It's another way to track our dividend snowball, and you can just see that we're getting $100 faster and faster every time. And if our portfolio is out there working a 40-hour-week job for us, it earned 36 cents per hour last update, but this update it's up to 38 cents. And July should be our record-setting month. We should be able to eclipse what we did back in April, so I'll be very excited to see how that happens. So that's why I love this strategy. The market, I may be down overall in my portfolio, but if the market turns, it's going to come back. So that's totally fine. I'm happy to wait, and I'm happy to be paid this income and buy shares at a lower price, and reach our financial goals in a shorter amount of time. So hopefully the sell-off continues for much longer. All right, so if you haven't joined Wealthsimple already, you can use my link in the description below, and you can get the value of a free stocks worth up to $6,000 if you use that code in the description. And have a great day, everybody, and don't forget to like and share and subscribe, and let me know what stocks you're looking into as the market falls, or maybe you're not buying anything, maybe you're hoarding cash. Let me know in the comments below. All right, have a good one.